weekly market insight where we try to sift through the noise, and there's a lot of noise, to get to the signal so you can have actionable advice and make informed decisions. And with me this week is Chris. He's joining. And Chris, what's going on through the market?
Another slow week.
Another slow week, hardly any headlines. There's not really much movement in the market at all. One of the things we thought we would talk about, because I think a lot of this is really coming from just trying to use monetary policy to solve all our economic problems. And one of the things that they had told us for quite some time is inflation is going to be transitory, supply chain disruption, that'll be transitory. It's not going to be long lasting. And here we are with the shipping issues still. Now, we talked about these earlier in the year, John and I did, and we did see a pullback in those, but now we're at new peaks for delay on anchorage. And there's all kinds of words that I've never heard of before that they're using to explain this. But LA port is our busiest port, and they still have a lot of problems there. We can see that the number of boxes shipped at anchor or in berth are higher than they were back in January. In addition, the volume index, which is, they measure them in TEUs, which is 20-foot equivalent units, which is just the shipping boxes. Those are at high, and what is concerning is the investment of supply management metrics, which is down here in the bottom right-hand corner. What that's saying is inventory on hand has been decreasing, and we're very low on the amount of inventory. You may have already noticed some of this in the big box stores. There's just not as much items in the grocery store. There's a lot of out of stock. I
just wanted to say, we also heard from the CEO of Union Pacific Rail that they're having the same issues with shipping, and he said they're really missing out on the top line revenue because they can move stuff all day on their rails, but they don't have enough trucks to take it off the rails.
Right. And then if we look, also this was put together by Jason Miller. He's an associate professor in supply chain management at the Michigan State University. And I just thought this was interesting because it shows change in sales, and sales are up. And inventory in some areas are positive, but nothing is exceeding sales. That means that they're selling their current inventory. Some areas have negative drops. There's a lot of issues in the supply chain whenever it comes to the logistics of getting produced products to the destination for sale.
What do you think's causing the inventory decrease? Is it lack of inventory, or are the managers forecasting lower demand so they want to run their inventory a little bit lower?
Demand seems to be very high. It seems to be a supply issue, which is just getting there logistically. Now, one thing that the Biden administration is pushing for is that the LA port go to a 24-hour schedule for gates. And many countries are already doing this. I would think that this is actually a positive thing. There's probably some union contracts or other things that have kind of made that inconvenient, as well as you got to get everyone to kind of go to a 24-hour schedule. That would be a positive in most situations, but it's probably not going to make an impact because it's not necessarily that the ports are only open a certain amount of hours. There's a labor shortage. It's the trucking industry that's really slowing this down because we just have a trucking shortage, and that's short-term day routes and long-term trucking. So that's going to be the issue, and it's also whipsawing. We're seeing it not just in the U.S. now. At one point, it was that all the boxes were coming over from China, and then they were just getting held up. So the price that they're paying for shipping has gone up dramatically because it's hard to get these Connex boxes. That's no longer the case. We're starting to see backlog as well off of China's port. So this is becoming a global issue as it whipsaws through, and we can see the congestion over off to the far right on just where things are happening. A lot of issues. Now, another thing that we're talking about is, well, this is producing the goods, and the problem is getting them to final sale. Well, what about a drop in production? Because the only issue is not a shortage of labor drivers. There's also an energy shortage that we're seeing, and it's really kind of global. But this is talking about China. This is a piece from Goldman Sachs. They've actually cut down their GDP forecast, which GDP is global domestic product,
right.
And basically production. So if they're starting to see a slow in production, it may be that we get some of the congestion down because of the issue in the supply chain of shipping, but then if on the other side you may not have as many goods and demand stays high, you can still see some prices.
And that looks like they cut it to zero, so they're forecasting no growth for the quarter.
No growth. I guess that means that they kind of would produce exactly the same amount, but we can see that demand's high. There's a lot of things going. Now, this is based on energy. This is not talking about Evergrande and the issues that they seem to be having across the economy in China. This is more, I believe they attribute it, and I think it's correct to attribute it to it, is a lack of coal. So there is an issue of getting coal from Australia to China right now. Some disagreements in their trade agreements, and China is very heavily dependent upon coal. So that's causing some energy issues in China.
So before moving on, you mentioned Evergrande. We talked a lot about that last week. You seen anything new week over week and what's going on in that?
Ultimately, I believe that the People's Bank of China will step in and provide liquidity. There will probably be a lot of people that take haircuts on this, but it's probably, depending on what your political affiliation is probably going to depend upon how much of a haircut you take on that. It's certainly going to slow down their GDP. Remember, GDP is very dependent upon their real estate industry. And one of the reasons that we, in most of our strategies, have really cut back our weighting for about a month now in emerging markets is there's certainly issues that we see in having exposure there. 30% of the emerging market index is China. So we have reduced our exposure there and do not see us making a change in the near term. In that Evergrande, we said we don't think that China's taking over. I compare it to my experience just out of memory of Japan was going to rule the world and their GDP was going to grow. I think it's going to be a very similar story out of China. And that's not even before we talk about the tech blockout that they've been doing. So energy is not the only problem in China. It's also national, and specifically right now in the Eurozone. Natural gas has gone very parabolic, the energy spike in the cost of getting natural gas in Europe. Why? Well, one, they already had limited supply of natural gas because they haven't had much of renewable energy coming online because there's just not as much wind this year. So then they had to use natural gas. Natural gas has become the capacity component for a lot of developed countries as they try to shift to renewables. We saw this in Texas, where during the winter they had a rough winter storm. There was snow, covered a lot of the solar panels. Wind and trying to heat the windmills was consuming a lot of electricity. It's 30% of their overall capacity. And then they had frozen pipes on natural gas, which they were trying to turn up. So then they actually had some blackouts. Similar thing happening in Europe with the slowdown in those renewables. They're highly dependent on natural gas. A lot of their nuclear plants have become old and they're not able to support the way they did. And then also you have Russia, which is providing their natural gas. Certainly a lot of geopolitics going on here, especially with the U.S. and there's a pipe in the Ukraine. The U.S. doesn't want Europe to be as dependent upon Russia. They certainly are becoming more dependent upon them with this new pipeline. Now, many say that Russia is withholding the natural gas for political reasons to place pressure. That may be true, but it doesn't seem like that's the only story. There seems to be a drop in production, and not just in Russia, but also globally. So
the price spikes were the highest in Europe. Do you think it's going to be contained there? Is it going to? Well,
it's a global market, so it's not easy and quick. So we don't have a pipe to ship them from the U.S. to Europe. But as we've gone through the recent administration change and some issues with low energy prices, there hasn't been a lot of fracking put in place in the U.S. So the U.S. production has declined. That's going to impact global markets. We still have to get it from the U.S. To Europe. I don't think we're going to see the stratospheric spike here in the U.S., but we are certainly seeing elevated prices in natural gas, and we're becoming more dependent upon it. So if you don't have a different options of going to coal and other gasoline and other energy prices, you continue to be more and more dependent upon a single source. The price of that or the demand of that single source is going to move up from time to time. So before you power your house, let's say in California where they have a lot of renewables and they've done away with a lot of their coal plants. You're not powering the electricity in your house through coal and the heat through natural gas. Everything's kind of dependent upon natural gas, especially if the renewables come offline.
And why would a spike in natural gas affect a diversified portfolio? Why are you even concerned about about the rise in prices?
One concerning part is oftentimes prior to a recession, you see a spike or an increase in energy or commodities, just base commodities. So we are beginning to see that. A lot of times that's because the economy is moving, we're starting to see inflation. Central banks are then going to see that inflation through the commodities and they'll lower rates. I don't think that's going to happen necessarily here. I think they're going to remain accommodative, continue to say, well, this is just transitory, we'll figure it out. But it is certainly a warning sign whenever you start to see commodity prices increase because that means that either the economy is becoming a little overheated or possible action by the Fed.
And you mean the Fed would raise rates, right?
Fed would raise rates.
Lower.
The European Central Bank would likely raise rates because if prices start to get too high, that's going to be the way that they're going to view it. A policy requirement is we need to slow the rise in price because we're starting to see inflation indexes hold up. Whether they'll do that or not is yet to be seen because they're going to often say, well, this is actually not a problem through monetary policy. It's just a problem with the overall economy and specifically unemployment. However, at the same time, we're having these shortages for people, and that's also in the United Kingdom. They're having issues with energy. One of the things is they're not having gasoline or what they would call petrol in their gas station, not because there's a lack of the gas, but because they're also having trucker shortages. So the central banks are really in a conundrum now because it's not an easy thing of trade-off between inflation and employment. There's just a lot of things that are moving because it doesn't seem that the economy is really synced up after all the lockdowns. Any other components?
No, I was just curious how long we can keep blaming supply chains because when the Fed first started blaming that a year ago, they didn't think we'd still be here 1 year now, still talking about this.
I would say that the economy is beyond complex, more complex than the Federal Reserve 12 members can understand, or any people. It's not that they're not smart, they're actually very smart. But how this is going to disrupt, it's better to let market prices figure this out, and that includes interest rates. And I think because we've tried to push this off, keep interest rates low, we're starting to get underinvestment in areas of the market that probably wouldn't have happened if we had a more true market-driven interest rate. And then also there's policies like ESG. I'm not saying that we don't want a good environment. I think people can make a case on whether this is or isn't going to provide that outcome. I think we all do want a positive outcome for the environment, but when we're looking at how much the energy sector, which is really the oil sector, it only makes up 2% of the index now. Are we underinvesting in energy? Have we underinvested in trade jobs like trucking by incentivizing or de-incentivizing different things? Whenever we start to tinker with this from policy standpoint, we can have outcomes and things that we just did not expect or want to happen. And I think this is certainly part of that. The lockdowns are certainly causing major disruptions in the supply chain, and this is a very synchronized economy. So one mess up somewhere can cause whipsaws all over the place, and I think that's what we're seeing. So then the transitory inflation, we have seen a reduction in the CPI a couple of times. This is still pretty strong looking back 12 months, 5.3% on the CPI. And most of it this time came from energy. So it wasn't used car sales this time. When we look at the price of over 12 months, still new vehicles have increased by, or used cars have increased by 31%, but that isn't what's driving this month. It's mainly the energy area. We saw an energy increase before coming out of this, but it was from a low base. We're pretty high now, so to see energy continue to increase, not from $1 something a gallon, but $2 and $3 a gallon, that's becoming concerning, and it's going to start crimping people's discretionary income. In addition, we think we'll see a revergence of food prices going up because food prices are so dependent upon energy inputs. Fertilizers are a major component of a byproduct of using energy, so that's one of the ways that we make soil more fertile. Also, you have carbon dioxide. This is weird and I find a little bit ironic, and this is a different carbon dioxide. I'm not talking about the utility plants, but we actually use a lot of carbon dioxide in food production, not just feeding plants, they take in CO2 and give out oxygen, but also in meat production. I don't understand how, but they somehow like kind of shock the animal before they go through processing with carbon dioxide, and there's actually a shortage of this kind of medical grade, let's call it, carbon dioxide in the system that is highly dependent upon energy. And then we have transportation costs. So not just a trucker shortage, but then you would have to ship the food to its final destination. Once again, a lot of energy inputs in the price of food. So if energy is increasing, I would expect to see another kind of wave in the food prices going forward for CPI.
Just a note that the Fed often kind of ignores the energy in food. If you don't use energy and you don't eat, they like to use a core measure of inflation, which last month was very low because, like you said, most of the gains came in this space. So it was only about 0.1 on the month.
Right. They will say that it's too volatile, so they remove it, and then they'll point out, well, look, the average would be lower if we take the things that went up a lot, and that's not how math works. Yeah. The average was including those things, so and we all have to buy them.
Right.
Volatile or not, we have to buy our energy, we have to buy our food. So another thing that we're starting to see is just how the monetary policy and the way that they measure affect. It's not a chart here, but if you look at where we would be if we weren't using rent equivalents, we would be at 12% on the CPI versus where we currently are, and that is because the home prices are excluded and they survey individuals. Now
CPI is not using actual rents to calculate their measure, right?
Right.
They're surveying what you would expect a rent to be from an owner of a property.
And I've seen some headlines of kind of what may be released on the most up-to-date owners' expectations, that they are probably now coming more in line with where we're seeing the other market, because people are expecting if they rented their house, they would get much higher prices. So that rent equivalence may be showing up in the CPI going forward. All of this is not really to do with supply chains. We would argue that it's monetary policy. Inflation is always and everywhere a monetary phenomena, and we can see we've been very, very accommodative, where if we were comparing the amount of public debt outstanding through COVID and then going back to the financial crisis of 2008, we were way ahead in the amount of money that we created. So we created it several weeks after the recession had started. So big injection of a lot of money early on, so we didn't see the long, prolonged downturn in the market, and we've produced a lot more money. So much so that if we were to actually start to look at how this is affecting the interest rate, just taking that CPI versus the Fed fund rate, you're losing 5.16%. Based on that inflationary number. So that's a lot of money to lose in purchasing power by trying to sidestep, which is a very volatile market right now, which we would recognize that there are some storm clouds on the horizon. We don't think it'll be a bad storm. We think it'll pass pretty quickly. We're hesitant to go into a defensive position and take cash, knowing that the solution continues to be just printing more money, and ultimately that's going to show up as inflation. Despite some of the indexes making it look like it's muted, we're seeing inflation elsewhere. So know that we're paying attention. Then the Treasury's rates are increasing. We don't know if it's because of the inflation expectations. They haven't pretty much throughout the year, though the CPI had been high. But it may have to do with...
Yeah, it may have to do with, I was just going to say, I think we have a slide of the Fed meeting from last week. And we got a little bit of news revolving around the dot plot and the forecasted taper. So this is 18 members on the FOMC and what they project rates will be going forward. And if we compared this to the last projection from June, you'll see that 2 new members have projected interest rates to go up next year. So now a median rate is to actually increase 25 basis points next year. Pretty small.
Mm-hmm. It is small. Another thing that could be affecting it is the debt limit, whether it's going to be extended or not, or if there will be what I would call a technical default, where they play chicken long enough, no one gives in, and all of a sudden we don't make the payments in a timely manner. The payments will be made. It's still going to be a technical default, though, meaning that if you had things lined up because you had matched a Treasury payment with a liability that you had, that can still cause disruptions. And if that happens, then interest rates would need to compensate for an additional risk. I think treasuries would still be considered a safe asset, but that could also be affecting interest rates. And we've seen interest rates affect the area of our flight to safety, which is growth. We're not going to make any changes yet. We still think that's the right play. But if treasuries are selling off,
right,
and we're in a flight to safety that's kind of related to that, but an equity type, then we're starting to see some pullback there. The growth has been underperforming on many up days, and also not protecting on the downside as well. That's a little problematic. Thankfully today we are seeing NASDAQ lead out of this. I think the probability of a default is very low, so we're not in a rush to make that trade, but if our signals tell us to in the qualified accounts, we will make that trade, even though there's a good chance we would be unwinding that trade quickly if that would pass. But we're going to follow our signals because that's our strategy, and if we don't follow our signals, we don't have a strategy. And it's one of the best performers year to date, despite having some trades that we've had to take on and then quickly remove. So.
And just wanted to point out one more thing on this slide. The most hawkish probably remark from the Fed is actually looking out 2 years. In 2023, last projection, there were still 5 holdouts that were not expecting rates to rise by 2023. Now there's only one. You're looking on that lower band at 2023, there's only one person expecting rates not to go up.
And they can change these over time. I would bet that we would not find the average rate on the dot plot be actually achieved during these time frames. It may go up. It's just they're always a little bit more aggressive about raising interest rates in the future, and then when the future finally arrives, they're like, oh, well, let's...
And we did get a little bit of more clarity on the taper timeline, still saying maybe and probably, but so we'll expect the next meeting in November to probably give actually what they're going to do, but the market is fully expecting the taper to start at the end of this year, and Powell said most likely to end the middle of 2022.
So then if we look at our themes, we continue to say inflation risk is high, even with a market that is being volatile right now. We're kind of in that time frame of the year, September, October, where we do see this. We don't think there would be a prolonged correction. There's a lot of cash on investment sidelines that could come in. We are seeing a pullback in the growth rate of money supply that's given us caution. We are considering some positions that we could put on that are defensive. We're not ready to make that change yet, but we want to find positions that would hold up well in a downturn, but we don't give up much if we see that upturn because we don't think it'll last long. So when we look at the price points, kind of retesting the previous week's low, went through it. Wouldn't be surprised to see 42.58 on the S&P achieved before this kind of goes through, and we could go as low as the 20-day moving average. Statistically, a correction happens about as often as your birthday or due, so we just don't expect it to be prolonged, and trying to make those changes, if it's not a prolonged, you'll miss up on the upside. So we're going to be cautious. Mentioned the money supply. We can see down here, May, June, we had substantial, in 2020, we had substantial growth in that money supply. It's starting to kind of be flat, and as expected, the market's starting to trade flat. Out of October, money supply usually begins to increase again. So this is a normal seasonal low or a slowdown. So we do expect the money supply to begin to climb. Still see positive yield curve. So a lot of our cautionary signals, we're just kind of, it's mixed. So we're not making an action on that. Starting to see some large cap growth lose momentum against the index on a relative strength. They're still above it. So that's positive. Once again, we're watching. We will make changes if we need to. We think we're in the right positions. If we go 2-3 months out, it just could be a bumpy ride here.
Interesting takeaway is the dollar index. You know, the market and the currency seems to be favoring the dollar. They believe the Fed that they're here to stop inflation, and mostly looking at that dot plot and raising rates.
Either that, or we're not doing as much accommodation as many of the other major currencies. And whenever I looked at the amount of relative to GDP, how much money was created, Japan was actually well ahead of the U.S., which is typically a currency you would go to. It holds up better than the U.S. dollar whenever you look at a downturn. So it's even more of a safe haven. And they did 57% of their GDP for that. So whenever you start to compare it, the U.S. has certainly printed a lot of money to try to solve these problems, but there are other countries and major economic areas and currencies that have done more than the U.S. So that might be another reason of why the dollar is doing a little bit better than the other currencies. If you have any questions, once again, we expect volatility for the next few weeks. Give us a call. We're happy to share what we see and what we think is going to happen and what positions. Know that if we enter a storm, we're going to be at the helm. We're going to be driving the portfolios, and we're going to make those changes if we deem that it's necessary. Once again, if you have any questions, reach out to your lead advisor. You can also go to the website and click there and request an appointment or a conversation with a lead advisor. If you haven't subscribed, please click that subscribe button. If you enjoyed this, hit that like button. It does help us in our rankings on the side, so other people may see this video. Anything else, Chris?
No.
All right, well, I'll leave it there. We appreciate you coming in this week, and have a good week.